Beat the Street by Peter Lynch. We will explore a classic investment book, Beating the Street. I will summarize the investment secrets of the famous American investor, Peter Lynch. Peter Lynch is a renowned investor on Wall Street. He started trading stocks at the age of 15 to earn his tuition fees. From 1977 to 1990, over 13 years, he managed the Magellan Fund at Fidelity Investments. During this time, he invested in more than 15,000 stocks, growing the fund from an initial $18 million to $14 billion, creating a miracle on Wall Street. Throughout these 13 years, he achieved profits every year, consistently outperforming the market. With such an impressive track record, Peter Lynch was honored by Time magazine as the world's best fund manager and by the American Fund Rating Company as the most legendary fund manager in history, making him a superstar in the American securities industry. Like Warren Buffett, Peter Lynch is also a value investor. Value investing involves the principle that stock investments are essentially investments in companies. When you buy stocks, you are actually buying a portion of the company's ownership. The focus should be on the company's operational performance and future development, rather than the fluctuations in stock prices. Therefore, the goal is to find good companies with growth potential and stick to long-term investments. Lynch frequently mentions Buffett in his book, and Buffett has also publicly recommended Lynch's books, showing mutual admiration between the two. Drawing from his investment experience, Peter Lynch has published several best-selling books, including One Up on Wall Street and Learn to Earn. The book we are discussing today, Beating the Street, was first published in 1993 and became the top bestseller in the United States that year, with multiple subsequent editions. Lynch wrote this book after he retired from managing the Magellan Fund, becoming an amateur investor. In this book, he documents his investment experiences and achievements and summarizes his 25 golden rules for stock investing. It's important to note that many examples in the book are from the U.S. in the 1980s and 1990s, with a few from Europe, the Americas, and Asia during the same period. Compared to today, many stock trading rules have changed, and some industries and companies have undergone significant transformations. However, Lynch's stock selection methods and investment strategies remain highly relevant and valuable for us today. In the book, Lynch summarizes 25 golden rules for stock investing, which I have synthesized into 3 main points. First, to make more money, it's best to invest in stocks and stick to independent stock selection. Second, the method of stock selection is an organic combination of art, science, and research, without leaning too much towards any single aspect. Third, for different industries and types of stocks, in addition to general methods, specific stock selection strategies should be applied based on their unique characteristics. Let's start with the first point: to make more money, it's best to invest in stocks and stick to independent stock selection. In Lynch's view, the returns from investing in the stock market far exceed those from investing in bonds and other securities. Even during the 20th century in the United States, when the market was often bearish and accompanied by economic crises, stocks still emerged as the ultimate winners. For instance, between 1926 and 1989, over 60 years, only in the 1930s did stock returns fall below bond returns. At other times, stocks outperformed bonds. If you had $1,000 to invest in 1926, 43 years later, that $1,000 invested in long-term government bonds would have grown to $160,000. However, if you had invested it in stocks, even just the benchmark return represented by the S&P 500 index, it would have grown to $2.55 million. Therefore, Lynch advises that if you really want to make more money, invest in stocks and allocate most of your assets to stocks. Even if a bear market might occur in the coming years, you should still do so. Additionally, as an amateur investor, you should stick to independent stock selection. By spending a small amount of time researching a few listed companies in industries you are familiar with, you can succeed. According to Lynch, professional investors like fund managers are often well educated in finance, familiar with the market, and knowledgeable about various financial indicators and techniques. In this regard, amateur investors cannot match them. However, professional investors also have their weaknesses. They might not be as familiar with a particular industry or company as the employees or users of that company's products. Therefore, employees or users of these companies have a unique advantage. They are very familiar with the industries they work in or the products they frequently use, so they should invest in stocks in these fields. This point is easy to understand. If you work at Intel, you certainly know more about Intel's development and operations than a professional fund manager. Or, if you are a loyal user of Apple products, you will have unique experiences and insights into Apple's products. To illustrate this, Lynch provides 2 examples in the book. One example involves some 7th grade students in Massachusetts who simulated stock trading and selected a portfolio of 14 stocks, including Walmart, Nike, Disney, Topps, a company that makes baseball cards, and Pentel, a company that produces colored pens. The reasons for selecting these stocks were varied, but all were decided after group discussions. For instance, they chose Walmart because of its rapid growth, Disney because almost every child had watched Disney cartoons, Nike because their shoes were very comfortable, Topps because almost every child had traded its baseball cards, and Pentel because its 2-in-1 pens were very popular among students. It turned out that this portfolio achieved a 70% return in 2 years, while the S&P 500 index, representing the benchmark return for stocks, was 26% over the same period. The student's portfolio clearly outperformed. Although this was a simulation, it used real companies and stock data, so if these children had actually traded on the stock market with this portfolio, they would have done very well. Another example is the National Association of Investors Corporation, NAIC, in the United States. In the 1980s, most club members of this association outperformed the market, while during the same period, 3/4 of stock funds did not. One key factor in the success of these club members was their adherence to regular, fixed-amount investments, meaning they invested a fixed amount of money at regular intervals, such as investing $10,000 on the 1st of every month. They stuck to this investment strategy regardless of market rumors or fears of a market crash, maintaining a steady investment approach. So, how did they select stocks? Specifically, the investment clubs met once a month, with each member responsible for researching 1 or 2 companies. They then shared their findings at the meetings and decided which stocks to buy next, with the decision requiring a majority vote from the members. Although this collective decision-making process has its drawbacks, it avoids the blind guessing of individual investors and reduces impulsive buying and selling. As a result, they mostly bought high-performing growth stocks, companies that operated well and saw annual profit increases. Such companies are likely to become 10-baggers, stocks that increase tenfold in value. If held for more than 10 years, these stocks could yield 10-fold, 20-fold, or even greater returns. Lynch repeatedly advises amateur investors not to buy stocks they do not understand. Instead, they should focus on a few companies they are familiar with, limiting their stock portfolio to around 5 stocks. Don't have too many, as your energy is limited and you won't be able to follow them all. But don't have too few either, because the portfolio needs to balance out the risk. Even if only one stock becomes a 10-bagger and the other 4 do not increase, your overall portfolio would still have tripled. Therefore, try to find some 10-baggers in your familiar fields. Even finding 2 or 3 in a decade would be highly rewarding. This is the first key point: to make more money, invest in stocks and stick to independent stock selection. Investing most of your assets in stocks yields returns far exceeding those from other securities. Amateur investors have their own unique advantages, and by spending a small amount of time researching a few listed companies in familiar fields, they can potentially outperform professional Wall Street investors. Now, let's look at the second point. Stock selection is an organic combination of science, art, and research, and one cannot neglect any aspect. Let me explain each part. The science part mainly refers to data analysis, which includes examining a company's financial statements, calculating and comparing various indicators and ratios, etc. This is an essential task in fundamental analysis since investing in stocks focuses on the company's performance. However, it's crucial not to get lost in a sea of data and reports. Fundamental analysis involves assessing the macroeconomic environment, the entire industry, and the specific company's basic situation. Even retail investors should avoid blindly trading stocks and instead insist on researching a company's fundamentals before investing. This helps gain a deep understanding of the industry and the company's position within it, which aids in timing the market effectively. Scientific stock selection emphasizes making judgments based on data. So, how do you conduct scientific stock selection? The basic method involves reading the news to understand the macroeconomic environment, examining financial statements to study net profits, debt levels, and the price-to-earnings ratio (P/E ratio) during specific periods. The P/E ratio is a metric used to assess whether a stock's price is reasonable. If the P/E ratio is too high, it means the stock is overvalued. If it's too low, it indicates the stock is undervalued. Lynch believes that, generally, the lower the P/E ratio, the better. Financial data used in scientific stock selection can typically be found through various securities companies or online. Lynch also offers some investment tips in his book. For example, a simple way to determine if a stock's price is high or low is to compare the stock's price trend with its earnings performance. If the stock price is equal to or lower than its earnings, it's a good time to buy. If it's higher than earnings, it poses a risk, and it's better not to buy. Additionally, you should view a company's development as a continuous process, not a series of disjointed events. In real life, if you initially judged that a company had investment value but ended up selling too early or not selling in time and incurred significant losses, there's no need to feel regretful or avoid the stock altogether. After all, value investing requires focusing on the long-term development of the company. Lynch believes that if you genuinely believe in a company, you should continuously monitor and re-evaluate its development, staying abreast of any new changes or turning points. It's advisable to re-examine your chosen stocks every 6 months and every 24 months. Lynch advocates for value investing rather than short-term speculation. If you've chosen a company's stock, it's best to hold it for a long period, ranging from a few months to several years, even decades. The market is ever-changing, requiring you to constantly monitor and adjust accordingly. Therefore, periodically checking your investment portfolio is crucial. This regular check is not just about observing stock price changes, but involves reassessing the current stock price against its earnings, understanding the reasons behind continuous growth in the company's earnings, etc. It's essentially a re-evaluation of your stock selection. You need to focus on the company's development status, analyze the fundamentals of each stock in your portfolio, and refrain from making random adjustments unless significant changes occur. So far, we've discussed scientific stock selection. Next, let's look at Lynch's artistic approach to stock selection. Here, art refers more to intuition and inspiration, derived from each investor's accumulated experience and life insights. For instance, people always yearn for bull markets, but Lynch believes that bear markets present better entry opportunities. In his view, a drop in stock prices does not necessarily mean buying, nor does a rise mean selling. When the economy is in recession and the stock market has hit rock bottom, it often means there are many undervalued stocks worth investing in. When the economy recovers, these undervalued stocks typically rebound significantly. In contrast, during bull markets, stock prices are generally too high, making it challenging to find worthwhile bargains. Therefore, for seasoned investors, bear markets are the best times to enter the market. Moreover, Lynch provides a simple strategy for making money through short-term operations, known as the January effect. In the U.S., there's a policy allowing tax deductions for investment losses in the same year. Consequently, every November and December, some investors sell stocks at low prices to take advantage of this policy, causing some stock prices to drop significantly. This is the time to buy. By January of the following year, these stock prices typically rebound, allowing you to make a profit. This year-end drop and subsequent early-year rebound phenomenon is known as the January effect. This effect is usually more noticeable in small-cap stocks, or stocks with relatively low market capitalization. After discussing the scientific and artistic aspects of stock selection, let's move on to how Lynch conducts research. Research emphasizes on-site visits and understanding the actual operations of companies. Lynch is known for this approach, earning him the nickname Diligent Rabbit.
In his book, Lynch describes how he utilized various opportunities for research while managing the Magellan Fund. He would call the management of target companies, visit listed companies directly, experience the company's stores on site, and test the company's products. Typically, Lynch would read 700 annual reports a year, have lunch meetings with company representatives daily, and make dozens of calls to brokers each day. He would visit over 200 companies a year, traveling more than 160,000 kilometers annually, which averages to 400 miles, about 600 kilometers per working day. Even during vacations with his wife, he chose destinations based on the presence of listed companies to visit. For example, he once avoided Venice, despite its beautiful scenery, because he couldn't find a single listed company worth visiting there. Lynch's diligence and obsession with research are evident. It's clear that there are no simple shortcuts or formulas for stock selection. Only by combining science, art, and research can one hope to make profitable trades.
Now, let's share the third point. For different industries and types of stocks, besides the general methods, it is also necessary to adopt specific stock selection strategies based on their unique characteristics. After Peter Lynch retired in 1990, the number of stocks he focused on and recommended significantly decreased. Previously, he would recommend hundreds of stocks each year, but in 1992, he only recommended 21 stocks for the well-known financial magazine Barron's. These 21 stocks covered various industries such as retail, real estate, finance, cyclical industries, utilities, and catering, and Lynch proposed specific stock selection methods tailored to their characteristics. We will focus on Lynch's stock selection strategies for the retail industry, distressed industries, and cyclical companies. These three areas are chosen because their situations and characteristics are quite common in China, making these strategies valuable references for Chinese investors. Let's look at Lynch's stock selection strategies for each. Retail industry stock selection, research while shopping. In Lynch's view, large shopping malls are stages where many listed companies fully display themselves and are also the best places to study company fundamentals. While shopping, you can observe which companies' products are popular and attract customers, which companies are declining, and which companies are undergoing transformation. Shopping mall employees have an insider's advantage as they can observe daily which companies' businesses are thriving or sluggish and gather more information from their peers. Mall managers can see the monthly revenue of various stores, which is excellent information. Lynch believes that many major stocks often come from these shopping centers. Of course, simply shopping isn't enough, other indicators must be combined for analysis. For chain retailers or restaurants, the main drivers of revenue and stock price growth are their rapid expansion status. If the revenue per store continues to grow, the company's debt is low, and it is expanding according to its annual report's development plan, holding the stock long-term will surely yield significant profits. For example, The Body Shop was a major stock Lynch discovered in a shopping mall. The Body Shop is a British company specializing in various cosmetics and skincare products. Once, while accompanying his three daughters shopping, Lynch noticed that the first store they rushed into was The Body Shop. Observing the bustling business and remembering recommendations from an analyst and a former colleague's investment, Lynch further researched and found that when The Body Shop stock was first listed, it was priced at 5 pence per share, and 8 years later, it had risen to 325 pence, a more than 60-fold increase. The company also emphasized health and environmental responsibility, using all natural ingredients. Despite the economic downturn in the U.S., The Body Shop's average revenue per store worldwide continued to grow. Lynch also noted the company's cautious expansion strategy, such as the chairman personally flying to the U.S. to evaluate a potential franchisee's capabilities. Distressed industries, finding outstanding companies. In distressed industries, excellent companies can often be found. Many people think that outstanding companies are those well-known in popular industries, but Lynch believes the best companies are often found in distressed industries. Like Warren Buffett, Lynch rarely invests in hot sectors like the internet or biotechnology, considering them too crowded and competitive. Instead, Lynch prefers slow-growing distressed industries where poorly managed companies are weeded out and survivors gradually expand their market share, eventually becoming industry leaders. These companies often have low operating costs, frugal management, minimal debt, a flat internal hierarchy, well-treated employees with shares, and monopolistic advantages in niche markets ignored by larger companies. For example, Sun Television and Appliances was a company Lynch discovered in a distressed industry. During the economic downturn of 1990 to 1991, the residential market was sluggish and few people bought new appliances, making the home appliance sector quite distressed. However, Lynch found that Sun Television and Appliances, a major discount appliance retailer in central Ohio, had 7 stores in Columbus and planned to open 22 more. Given that nearly half of the U.S. population lived within a 500-mile radius of Columbus, the market potential was significant. Lynch discovered that Sun Television's debt was under $10 million, its annual earnings growth rate was 25 to 30%, its stock price was $18, and its P/E ratio was 15, indicating it was undervalued. When Lynch called the company's headquarters for more information, the president answered quickly, suggesting a flat internal hierarchy. Consequently, Lynch recommended this stock to barons, and his prediction of its growth in 1992 proved correct. Cyclical companies, timing the market. Investing in cyclical companies requires choosing the right time, preferably entering when the economy starts to decline. Cyclical companies, such as those in aluminum, steel, automotive, chemical, and aviation industries, experience ups and downs in sync with economic cycles. Savvy investors act ahead of the market when cyclical companies are about to recover. For cyclical stocks, a low P/E ratio can be misleading. A low P/E may indicate the cycle's end, with smart investors already selling off their stocks. Thus, for cyclical stocks, a high P/E ratio can be a good sign, indicating the company has emerged from difficulties and its business is improving. Choosing cyclical stocks requires intuition and double the skills and capabilities. Buying too early or selling too early carries significant risks. Additionally, it's crucial to understand whether the company's financial health can withstand the next downturn, and without industry experience, it's best to proceed cautiously. For instance, Lynch's investment in General Motors stemmed from his astute judgment of the automotive industry's cycles. Lynch believed that as long as there was no better transportation alternative, Americans would continue buying cars. Despite various influencing factors, Lynch found that the difference between actual sales and potential market demand, calculated based on population and previous sales, could reveal a suppressed demand when actual sales lagged behind potential demand for 4 to 5 years. This suppressed demand eventually leads to a sales boom. Analyzing the cycle from 1983 to 1988, Lynch saw that the suppressed demand accumulated and was gradually met by increasing sales. By 1993, Lynch predicted another significant suppressed demand, suggesting an automotive sales boom between 1994 and 1996, making 1992 an ideal time to invest. Lynch also emphasized selecting the right company within the right industry. In 1991, General Motors' weak U.S. sales contrasted with strong overall revenue due to profitable subsidiaries, such as finance and electronic data systems, compensating for domestic market sluggishness. Lynch predicted GM's per-share earnings would reach $10 post-recovery, and this prediction proved correct.